Navitas Semiconductor's ticker NVTS is currently trading at 8.08, down just about 0.31% on the day, a tiny move, barely a flicker, and that right there is the perfect cover for what's really happening. The expectation is that this is just another sleepy semiconductor stock drifting with the market. The reality, that 8.08 price point is the fragile, calm surface of an ocean, and underneath there's a powerful battle between two completely different narratives. On one side, you have the next-generation power story, the one that gets retail investors excited on platforms like the Robinhood app or SoFi Invest. On the other, you have the brutal reality of cash burn, cyclical risk, and intense competition, which is what the professionals using the Interactive Brokers trading platform are modeling out in their spreadsheets. This isn't just a stock. It's a bet on whether a new technology can outrun its own balance sheet. And today's quiet price action is just the market catching its breath before the next big move. The common ground, the story everyone believes they're buying, is easy to understand. Navitas designs and sells Gallium Nitride, or GaN, and Silicon Carbide, or SiC, power components. This is the new stuff. For decades, everything from your phone charger to your power grid has run on old-school silicon. It works, but it's slow, it's bulky, and it wastes a lot of energy as heat. GaN and SiC are what we call wide-bandgap materials. They are fundamentally better. They can switch power faster, run at higher voltages, and are incredibly efficient, meaning they're smaller, lighter, and cooler. This isn't a small improvement. It's a step change. This efficiency is why your new laptop charger is the size of a small ice cube instead of a building brick. It's why modern data centers can pack in more computing power without melting, and it's absolutely critical for electric vehicles and solar inverters. The expectation is that this technology will replace silicon in a massive wave, and Navitas, as a pure-play company, is perfectly positioned to ride it. This is the simple, compelling story that makes online investment in a stock like this seem so obvious. It feels like getting in on the ground floor. But that's where the expectation runs headfirst into the complex and, frankly, difficult reality. Let's look at the recent movement because this is where the real story is. Today's 0.31% dip is meaningless noise. What's not meaningful is the high-volume chop we've seen over the last quarter. After the company's last earnings report, the stock ripped higher, then gave back nearly all of it in the following weeks. Why? Because the report was a perfect example of the Navitas contradiction. The expectation was revenue growth, and Navitas delivered, posting huge year-over-year gains. They showed design wins in data centers, progress in the EV market, and continued dominance in the fast charger space. The bulls cheered. But the reality? The net loss also got wider, a lot wider. The company is spending a fortune on R&D and sales to capture this growth. This is the classic high-growth dilemma. To win the market, they have to spend. But in a high-interest rate environment, the market has no patience for companies that burn cash indefinitely. This isn't Apple stock, a $2 trillion fortress that prints billions of free cash flow every quarter. This isn't even Tesla stock, which, despite its volatility, has achieved scale in profitability. Navitas is a $1.5 billion market cap company fighting against $100 billion giants. The market is looking at this company and asking a very serious question. Can you get to profitability before your competitors like Infineon, ST Microelectronics, and Wolfspeed decide to crush you, or before you run out of cash and have to dilute shareholders with another offering? This is the fear that's keeping a lid on the price. This is the reality that automated tools, say a Schwab Intelligent Portfolios account, might miss. That robo-advisor sees high growth and tech sector. It doesn't see the brutal street fight nature of the semiconductor business. This kind of self-investing requires you to look past the marketing. Let's dig into that recent action. The stock is currently sitting just above its 50-day moving average, but it's still well below the 200-day, which is a classic sign of a market that's skeptical of the long-term trend. Volume today is light, suggesting the big institutional players are on the sidelines. They're waiting. They're watching the data coming out of the EV sector, which has been slowing. They're watching consumer electronics sales. A lot of the online investing crowd, especially those using Robinhood stock trading, see Navitas as an EV play because of its SiC business for onboard chargers. But if EV sales are sluggish, that's a direct hit to one of Navitas's biggest growth stories. This is a very different risk profile from a broad market Fidelity mutual fund or one of the many Fidelity ETFs. This is a high beta, single stock bet. This is also where we have to talk about the broader market. We're in a very strange place. The headlines are dominated by AI, which has sent NVIDIA stock into the stratosphere. Navitas tries to tie itself to that narrative. They correctly point out that AI data centers consume astronomical amounts of power, and their efficient GaN power supplies are essential. This is their new big expectation. But the reality is that the market hasn't fully bought in. When investors want to buy AI, they buy the picks and shovels leader, NVIDIA. They don't, as a first choice, buy the power supply component company. Navitas is seen as a secondary, more speculative play. This is why you see so many retail traders on platforms from Fidelity to SoFi piling in, while some Fidelity wealth management divisions might be telling their high-net-worth clients to wait for proof of profitability. When you're managing a Fidelity individual brokerage account or even Fidelity IRAs, you have to decide what kind of risk you're willing to take. Navitas is at the far end of that spectrum. So what does Navitas actually do? Let's be specific because the technology is the whole story. The company is built on two pillars. First, Gallium Nitride, or GaN. Navitas has been a leader here. They developed what they call GaNFast, which integrates the GaN power chip with the driver and control electronics all on one piece of silicon. This integration is their key intellectual property. It makes it easier for designers at companies like Samsung or Dell to use their product. This is their beachhead market, the little 65-watt or 100-watt fast chargers for phones and laptops. They own this market. The expectation is they can use this leadership to push into higher power applications, like those data centers. The reality is that the data center market has a brutal design cycle. It can take 3 years to get designed in to a new server. So the revenue from that AI story is a long way off. The second pillar is Silicon Carbide, or SiC. This is the high-power, high-voltage stuff. Think 800-volt EV architectures, solar grid inverters, and industrial motors. Navitas got into this market through an acquisition. This puts them in direct competition with established giants, most notably Wolfspeed. The expectation is that the EV market will grow so fast that there's room for everyone. The reality is that the EV market is slowing and Chinese competitors are flooding the SiC market, putting massive pressure on prices. This is where Navitas's Fab-Lite model becomes a double-edged sword. They don't own their own multi-billion-dollar fabrication plants, which keeps their capital costs low, but it also means they don't control their own supply chain and may have to compete for capacity at their manufacturing partners, like TSMC. This is the kind of granular detail you need to understand, which you won't get just from looking at the SoFi stocks popular list or using the basic Fidelity mobile app. This requires a deeper understanding of the industry, the kind that platforms like the Interactive Brokers account services are built for. So let's look to the future. What are the catalysts and what are the risks? The bull case, the expectation is clear. Catalyst 1. The AI data center market continues its explosive growth and Navitas successfully transitions from a charger company to a core data center and AI supplier. They start announcing major design wins with cloud providers. Catalyst 2. The EV market re-accelerates, and their SiC products gain market share in next-generation vehicles. Catalyst 3. They finally cross over into positive free cash flow, proving the business model is sustainable. If those things happen, 8.08 will look ridiculously cheap. Now, the reality, the risks. Risk 1, competition. It's the elephant in the room. What's to stop Texas Instruments or Infineon with their massive scale and customer relationships from just undercutting Navitas on price until they bleed out? Risk 2, the macro environment. If interest rates stay high, it's a double whammy. It hurts demand for their end products, EVs, laptops, and it makes their cash